Michael Burry was one of the investors who predicted and made millions during the housing crash of 2008. His large and unique bets against the market solidified him as a legendary investor. And today, he is the manager of Scion Asset Management, which has $230 million in AUM. Last week, all of the super investors' 13F filings came out. These filings require asset managers with over $100 million in AUM to report to the public all of the moves they're making within their portfolios. These 13Fs are a goldmine of potential stock ideas, as we can see what the best investors in the world have been buying and selling. Michael Burry's 13F revealed that he has been adding to some of his existing positions quite substantially. In the next few minutes, I'm going to take you on a deep dive of the 5 stocks that have caught Michael Burry's eye. We'll unpack what potential Burry might be seeing in them, and if they're still looking interesting today. But before we get into the video, I just want to let you all know that Stock Unlock is currently having a 25% off Black Friday sale. So if you have been waiting to check out Stock Unlock, then there's no better time than now, because you can get a yearly subscription for only $5.63 per month when you buy an annual subscription. That is ridiculous value, since you can track your portfolio, dividend payments, and quickly identify good and bad stocks with our fundamentals-focused scoring system. So don't wait and go and save 25% on your subscription now. So let's hop into Michael Burry's portfolio now. And here we can see that his number one holding is Alibaba at 25% of the portfolio, JD is 24%, 4 is 16%, Baidu is about 16%, and then the next major holding is MOH at about 12.5%. Now, as we probably know, Alibaba, JD, and Baidu are all Chinese stocks. So Michael Burry's total allocation to Chinese stocks now is about 65%, or the majority of the portfolio. So needless to say, he seems very bullish on China now. We can also see that he has been adding to all of these major positions, and he's trimmed his real and ACIC position. This screenshot doesn't show it, but Michael Burry also sold out of his HPP position, which was a brand new buy in the last quarter. And when I discussed Michael Burry's portfolio last quarter, HPP was a very strange position. This is a real estate company that's really not performing well, so I'm not surprised that Michael Burry cut this one from the portfolio. So now let's discuss the actual holdings in depth. And I want to discuss the 5 top holdings of Michael Burry that make up the vast majority of his portfolio. So let's start off with the 3 Chinese stocks and with Alibaba. So first off, I actually want to show a chart of China's total disposable income from all of its consumers, because we can see right here that from 2021 to 2023, and even really into 2024, the disposable income of Chinese citizens was pretty much flatlining. And this ultimately resulted in not a lot of growth for companies like Alibaba and JD, because people didn't really have that much more money to spend. However, out to 2029, Chinese citizens' disposable income is projected to grow by about 40 to 50%. So it seems like analysts are quite bullish that there will be a tailwind in China, and this should ultimately result in some growth or accelerated growth for Alibaba and JD especially, if this actually does come true. So we'll have to see if it does. All right, so now let's move on to Alibaba's third quarter 2024 financial results. And right here, we can see that the company's total revenue did grow by 5% year over year on the quarter. So Alibaba's top line is continuing to grow. However, we can see that Alibaba's main segment of the business, which is their e-commerce business, only grew by 1% on a year over year basis. Their cloud intelligence group grew by 7%, and Alibaba International grew by 29%. So Alibaba's international segment is still growing very well, and the cloud segment is actually starting to see accelerated growth. But again, the business only grew by 5% year over year. However, if we take a look at Alibaba's operating cash flows, we can see that it did decline by about 30% year over year to about $4.5 billion on the quarter now. Alibaba's capital expenditures also increased by 4x to $2.4 billion in the quarter, which ultimately resulted in its free cash flow declining by about 75% on a year over year basis to about $2 billion in the quarter. Free cash flow year to date is also down by about 60 to 70% due to the higher capital expenditures and lower operating cash flow. So year to date, Alibaba has only generated about $4.4 billion in free cash flow. Then Alibaba discusses its cloud intelligence group right here, where it says double-digit public cloud growth and AI-related product revenue grew at triple digits year over year for the 5th consecutive quarter. We continue to invest in anticipation of customer growth and in technology. So Alibaba is currently going through an increased capital intensive cycle where they're investing back into the business and really trying to invest in their cloud infrastructure and international growth. This is kind of like what Google and Amazon are doing right now, because these two businesses are spending a record level on capital expenditures, which is causing their free cash flow to decline. And it kind of seems like Alibaba is going through kind of a similar thing. Alibaba also says Alibaba consolidated subsidiaries increased 7% year over year, mainly driven by the double-digit revenue growth from the public cloud products, including AI-related products, partly offset by the decrease in non-public cloud revenue as we transition away from low-margin project-based revenues to focus on high-quality revenues. So Alibaba's cloud segment is seeing a little bit of a headwind towards top-line revenue growth because they are running off lower margin revenue. They're not renewing these contracts. So once this runoff period is done, then Alibaba is projecting that the cloud business will grow at double-digit growth rates once again. And here we can also see that Cloud Intelligence Group adjusted EBITDA increased by 89% year over year. So the bottom line of the cloud business is absolutely exploding because, again, they're running off that low margin business and bringing in a lot higher margin business that they believe is also higher quality. And I do agree. This article right here also says that mainland China's cloud service spending is projected to grow by 18% in 2024. Alibaba Cloud is also the leader in China's cloud infrastructure with 39% market share. So as China's overall cloud computing industry continues to grow, then Alibaba should continue to grow with it because, again, they are the #1 leader in China's cloud industry. So let's head over to Stock Unlock now and take a look at Alibaba's fundamentals here. So first off, let's take a look at the revenue. And we can see that Alibaba's long-term revenue growth is intact and the revenue is in fact hitting an all-time high again. The revenue growth recently really hasn't been that much. But again, if China's economy and the consumers can start to see better financial health, then Alibaba's revenue could start to re-accelerate once again. So now let's take a look at Alibaba's operating cash flows, and we can see that they are currently in a downtrend, and Alibaba's overall free cash flows are in a downtrend as well. So the company is definitely going through a period where it is increasing its overall investments back into the business, which hopefully should result in higher growth rates in the future. Now, if we also take a look at some of Alibaba's KPI data right here, we can see the Cloud Intelligence Group revenue. And we can see that it is starting to grow and slightly re-accelerate once again. However, if we take a look at the Cloud Intelligence Group adjusted EBITDA, we can see that it is absolutely exploding. So when the runoff is done for the Cloud Intelligence segment and those headwinds do stop, and the overall top line of the cloud segment does start to re-accelerate again, then the adjusted EBITDA should also start to grow, well, actually just continue growing at a very fast growth rate. So ultimately what I am trying to say is that Alibaba is kind of going through an investment phase right now, but over the long term, this company's margins and cash flows should pick up and start to accelerate again. So for me personally, I do think that Alibaba is still looking like an attractive stock in the market, and I do see the long-term run rate for this business and its future growth. So while this stock is in a massive correction and down roughly 80% from its all-time highs, I do think that it is looking interesting, and for those reasons, I also hold Alibaba in my portfolio, and I do see why Michael Burry is also bullish on this stock. So now let's move on to JD.com, which is Michael Burry's second largest position. Now, JD is another massive e-commerce and retailing company in China, and this stock has now been flat since roughly 2015. So it's seen almost a decade of no growth to its share price now. We can also see that the stock is down roughly 64% from its all-time highs. Now, JD also recently reported its earnings, and I do have some screenshots here that I want to go through. So here we can see that as of the most recent quarter, JD's revenues did grow by 5.1% year over year, which is pretty much in line with Alibaba's 5% year over year growth rates. So these two companies are growing at 5% right now. JD's retail operating income did come in at 11.6 billion RMB, and their operating margin did come in at 5.2% as well. JD Group's non-GAAP net profit margin was also 5.1% and seems like it is continuing to grow. So the main difference between JD and Alibaba is JD seems like it is focusing on trying to improve its profitability and maintain profitability, whereas Alibaba is clearly seeing its profit margins drop right now, as again, it is reinvesting back into the business. So these two companies are kind of doing things a little bit differently from each other right now, despite growing their revenues at about the same rates. In this next slide, we can see that JD's free cash flow in the trailing 12 months is now 33.6 billion RMB, which does translate into about 4.6 billion US dollars in free cash flow. So let's head back over to Stock Unlock now and take a look at JD's long-term revenue growth and see the trend here. So just like Alibaba, they did have strong revenue growth up until about 2022, and now the revenue growth has been decelerating and slowing down. However, the revenue is clearly still at an all-time high. If we now add in JD's operating cash flows in the trailing 12 months, we can see that they are down a little bit at about 52.8 billion RMB now. So JD's operating and free cash flows are not at an all-time high. And again, they have done about $4.6 billion in free cash flow in the trailing 12 months now. What we can also do is take JD's market cap of about 408 billion RMB and divide it by 33.6 billion in free cash flow that they did in the trailing 12 months, which means that JD is now selling for about 12.14 times free cash flow. And if we go 100 divided by 12, that means that they are now trading for about an 8.3% free cash flow yield. Now, personally, I am more interested in Alibaba with their cloud dominance over in China and with their reacceleration of cloud that should end up happening. Basically, I think that Alibaba has a little bit more of a stronger moat than JD, and therefore I am not too interested in JD and I just hold Alibaba instead. But I can see why Michael Burry is interested in this stock as well, as it is one of the market leaders in China, and it seems like its price today is not absolutely absurd. So he's clearly allocating more capital over to JD too. All right, so now let's move on to the third Chinese stock that Michael Burry is adding to, which is Baidu. Now, very quickly, Baidu is kind of like the Google of China. They're like the #1 search engine over in China. And what's interesting is this stock is now basically flat since 2010. So it has seen roughly 14 years of zero share price appreciation. And the stock is down about 73% from its all-time highs. So it seems like Michael Burry is buying the dip big time on Baidu. Baidu also recently reported its third quarter 2024 financial results. And here we can see that its revenue actually declined by 3% year over year, and its operating income also declined by 6%. Its net income also declined by 19%, its diluted earnings per share declined by 19%, and its adjusted EBITDA declined by 8%. Baidu's core business saw year-over-year revenue growth of 0%, no operating income growth, net income declined 18%, and adjusted EBITDA also declined by 2%. So unlike Alibaba and JD, Baidu's business is actually seeing its top line decline, and all of its profitability and profit margins are also declining, which I do not like to see at all. It's not ideal. So let's head back over to Stock Unlock and take a look at Baidu's long-term revenue growth. So over the long term, its revenues have compounded very, very well. But as we zoom in, the growth rates to Baidu's revenue seems to seriously slow down. And again, right now, it is currently seeing its revenues decline. So it seems like Baidu may not have as strong of a moat as Alibaba or JD, because every metric for this business seems like it is currently going down. Baidu does have a very strong balance sheet though, with more cash than total liabilities, so the company's financial health is very strong. It just seems like this company is facing significant headwinds right now and not really growing. Its price to free cash flow is only 7.3 today, which is a free cash flow yield of 13.7% though, and at this free cash flow yield, the business could return a significant amount of cash back to its shareholders, and maybe that is why Michael Burry is interested in this stock, simply because its price is so low in the market today. But let me know what you guys think down in the comment section below, because personally, I'm not too interested in Baidu while the business's revenues and cash flows are currently declining, and all of its profit margins are declining as well. Again, I simply think that Alibaba is the best Chinese stock to own, and for that reason, Alibaba is in my portfolio, and Baidu isn't. All right, so now let's move on to the next stock that Michael Burry is continuing to buy, which is Shift4 Payments. Now, he initially bought this stock in his last quarter update to the public, or in his last 13F filing. And when I went through the 13F filing last time on my channel, Shift4 Payments was the stock that I was the most interested in. This one seemed like it had the most solid fundamentals, and at that time, it was trading for only about 20 times cash flows while growing its revenues at 30% annually. So a 20 multiple for 30% annual growth seemed very interesting to me. Now, since that last video, Shift4 Payments is up roughly 50% though, but it seems like Michael Burry is continuing to add to this stock. Now, I'm going to play the clip that I made in my previous Michael Burry 13F video where I discuss Shift4 Payments business. So I'm going to play that clip and basically explain what Shift4 Payments does. Shift4 Payments is a payments platform, but what makes this company unique is it creates software in addition to the payments platform. For example, Shift4 Payments has a technology called SkyTab, which they say is more than just a POS system. It's an all-in-one restaurant platform that will transfer your business from front of house to back of house and everything in between. So this is like a restaurant management platform that also happens to have a point of sale system built into it. So again, Shift4 Payments is not just a POS platform, but they also have different software and technologies for different industries such as restaurants. And the restaurants use this technology to help manage their businesses as well. Shift4 Payments also recently reported its third quarter financial results, and right here we can see that they put out 56% plus year-over-year end-to-end payment volume growth, 48% gross profit growth, and 50% gross revenue growth. So this business is continuing to grow extremely well. In Q3, its end-to-end payment volume came in at $43.5 billion, which is a 57% compounded annual growth rate since the third quarter of 2020. Since the third quarter of 2020, its payment volumes are also up 6x. This next screenshot shows us the net cash provided by operating activities and the adjusted free cash flow. And in the third quarter, operating cash flow came in at $182 million, and adjusted free cash flow was $110 million, which was up roughly $40 million year over year, or about 50%. So the cash flow that this business is generating is also growing extremely well. Then Shift4 Payments gives us their updated guidance and outlook for the full year of 2024. And they are now expecting about $1.36 billion in revenue, which is growth of 45% year over year. So this business's top line is still growing at over 40% annually as well. And then at the bottom, we can see that they are expecting 58% plus adjusted free cash flow conversion from their adjusted EBITDA, which works out to roughly $400 million in free cash flow for 2024. So that is the company's free cash flow expectation. Now, if we head back over to Stock Unlock really quickly, we can see that the market cap of the business is $10.4 billion today. So if we go $10.4 billion, divided by $400 million in expected cash flows, then this means that the business is now selling for about 26 times the 2024 expected free cash flows. This ultimately means that Shift4 Payments price ratios have expanded since the last video that I made on Michael Burry's portfolio, but a 26 times price to free cash flow for a business where its revenues are growing at over 40% annually doesn't seem that absurd to me. And if Shift4 Payments can maintain this 30 to 40% annual revenue growth, then a 26 multiple actually does seem pretty dang cheap for this business. So for that reason, I am still interested in Shift4 Payments, and out of all of the buys that Michael Burry has done in the most recent quarter, this is still the most interesting stock in my opinion. All right, now the last major buy that Michael Burry did in the quarter was on MOH, or Molina Healthcare Inc. And since its IPO in 2003, the stock is now up roughly 1900%, or is a 19x return. So it has massively outperformed the S&P 500 over the longer term. However, the stock is currently in about a 30% correction from its all-time highs, and it does look like Michael Burry is continuing to use this correction to increase his position in Molina Healthcare. And just like Shift4 Payments, Michael Burry did buy this stock in his second quarter update, and I did do a really quick segment explaining Molina Healthcare's business in that video, so I'm going to play that clip now, and then afterwards I will further discuss the update for this stock. MOH is a health insurance company that provides Medicaid, Medicare, and other government-funded health insurance programs. Now, why I think that Michael Burry may be buying this stock is because Medicare expenses are projected to grow by 7.4% annually all the way out to 2032, and Medicaid expenses are projected to grow by 5.2% annually over that same time frame. Additionally, Medicare enrollment is projected to increase up to 60% of the eligible Medicare population by 2030. So more people are projected to sign up for and use Medicare all the way out to 2030. And with the average Medicare expense and the number of people using Medicare both expected to grow, this should provide two tailwinds to MOH's business over the next 6 years. All right, so now let's head back over to Stock Unlock and take a look at Molina Healthcare's updated financials. So here we can see that its revenue did hit an all-time high in the most recent quarter at about $39.2 billion now. If we scroll down, we can also take a look at its net income right here. And net income is continuing to grow. It is at a slight all-time high right now of about $1.14 billion. So now let's take a look at some of Molina Healthcare's most recent business highlights and its outlook for 2024. So right here, this says, as of September 30th, 2024, the company served approximately 5.6 million members, an increase of 8% year over year. The company reaffirmed its full year 2024 guidance with expected premium revenue of approximately $38 billion and adjusted earnings of at least $23.50 per diluted share. So if we head back over to Stock Unlock really quickly, we can see that Molina Healthcare closed on Friday at $297.90. So if we divide this by $23.50, then we get a forward price to earnings ratio of about 12.7 based on Molina Healthcare's expected earnings per share for 2024. So this business is trading for a 2024 earnings multiple of about 12.7 today, and its revenues are growing by about 18% as of the most recent quarter. So 18% revenue growth for a price to earnings ratio of 12.7 does look pretty interesting to me, but maybe the stock is in a little bit of a correction with the new Trump administration coming in, and maybe some uncertainties around what is going to happen to the US healthcare. So maybe that is kind of adding some uncertainty to this business, and maybe the market is selling off the stock for that reason. But ultimately, this stock is looking arguably cheap in the market, again with a low price to earnings ratio and still pretty strong top line growth, and the business's revenue is continuing to hit all-time highs. So those are the top 5 stocks that Michael Burry is buying in the third quarter of 2024, and let me know what you guys think down in the comment section below, because he does still seem very bullish on Chinese stocks, and I know that Chinese stocks are kind of a polarizing topic today. Also, if you guys are interested in checking out Stock Unlock, which is the portfolio tracking and stock analysis platform that I use here on my channel, then again, you can save 25% on your subscription right now with our Black Friday sale that is ending Monday. So don't wait, because we don't do a lot of sales for Stock Unlock. So right now is the time to lock in your 25% discount and check out the platform if you are interested. But with all that being said, that is going to wrap up the video for today, everyone. So as always, thank you so much for tuning in. And if you did enjoy the video, then please remember to leave a like on it. And if you are new here, then please consider subscribing to my channel as well. As always, I truly do appreciate you guys tuning in, and I really hope to see you all again in my next video.